Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be doing a quick video going over two stocks that were suggested to me by a viewer and subscriber here at the Financial Investor channel. We're going to be taking a look at Lam Research, ticker symbol LRCX, and also Roper Technologies, ticker symbol ROP. Now, I'm not very familiar with these stocks, so we're going to be doing a 1,000-foot overhead looking down at their financial metrics. They're also dividend paying stocks. So we're going to use dividend.com to see how long they've had dividend growth, how many years, what's their payout ratio, when do they pay out, how much do they pay out. Also, we can go take a look at Yahoo Finance over the last 4 quarters. Have they beat expectations, beat their earnings? And I've added a couple different financial metrics in here. I was talking back and forth with a member of my Facebook group over 3 metrics he would use to evaluate a business. I said, I like to look at growing revenue, net income, price to sales. His 3 were ROIC, which is return on initial invested capital, and cash conversion cycle. And I'll explain these here in just a minute. I didn't know them myself before I kind of read into them just a little bit more, and I would like to use them kind of going forward. They do look like really good financial metrics to use. So return on invested capital is, as it sounds, the definition is basically return on invested capital is a calculation used to assess a company's efficiency at allocating the capital under its control to profitable investments. So basically, how well does that company use the capital that it's given in order to generate money? So if we take a quick look at Apple, for example, and we go back at the 10-year mark, if we look at where did their iPhone get released at, it was back in maybe 2008. So you can see here they were coming down for quite a while. They were down, down, down. Maybe they released something here during this time. I'm not sure if that was the iPad, what products or services they had during this time, but they rode your return on investment between 1998 and 2000 was very high. Then we had that crash in 2000. It kind of, it came back to a value buy, and they had came down for quite a while. Then they began working on some new products. They put out the new iPhone, and they have just begun to go crazy during that time. You can see here that they've kind of, this is still great returns. So this is per year, this isn't the performance of it. This is just if you look at a specific year, what would your return of capital be in 2010? It would be right around 25% of your, in your invested money. Currently, for the current year in 2018, you're looking at your return on invested capital of around 21.6%. And if you take a look at some of these other value stocks, ADP 29.6, Procter & Gamble at 11.3. So this is a little bit slower grower. Not as fast as, say, a Procter & Gamble. If you look at NVIDIA, this one's going to be, 43%. So that's basically double right now of what Apple, and that's pretty, NVIDIA's working on their graphics cards, improving. There was a whole crypto phase last year. So that's a pretty good estimate to just see whether that company can turn your money into more money and how fast they can do it. Like, what is its invested capital rate? And then we have the cash conversion cycle. Here, this is just how many days does it take them to take their resources and convert it into cash flows. So here, for example, they said that the cash conversion cycle attempts to measure the amount of time each net input dollar is tied up in production and sales process. Let's see here. In the sales process before it is converted into cash through sales to customers. So taking their assets and their input, let's see here, taking their converted resources, how many days does it take for them to actually make it profitable from their sales to the customer? So here again, we'll go back and take a look at, whatever, Procter & Gamble has a number of products out there. You can see that it takes them actually negative 19.95 days. So they're able to make a conversion very quickly, actually beating positive numbers. So you want to see negative numbers here. This is just, the more days that it takes them to convert their resources over into cash flow, that is just, wasted time. Here, ADP doesn't even show up on the chart. Apple is negative 39 days, so they're actually just chumming out money left and right with what they're given. And the video here, it takes them 50 days. Maybe they make a product it sits on someone's shelves for a while, and it doesn't get quickly turned, into a customer sale. So those are our two financial metrics we're going to be using kind of going forward. And hopefully I didn't take too much time. Hopefully those are new to you as financial metrics, and maybe you guys can take a look at them as well and begin using them in your screening process. So let's go ahead and look at our two stocks. I know we're already 5 minutes into this. Of course, if you are brand new to the channel, hit the subscribe button. Otherwise, if you are a recurring viewer and subscriber, thank you guys for watching. I really appreciate it. So Lamb Research. So let's take a look at, very first thing I like to take a look at myself is price earnings ratio currently and where it's going in the future. So here currently at 16.4, in the future is expected to grow in their earnings. If we bring in Yahoo Finance, over the last 4 quarters, this company has beat expectations on their earnings, and over the last 2 quarters alone since they've done the tax reform, this company has not only beat earnings but have basically doubled and tripled over their expectations. So going forward, you can see that's why that big difference there. They're going to be dropping from a 16.4 current price in comparison to their earnings to a 10 where they're currently priced. They actually came down off their highs here. If we bring in their price here, they came down off these highs. They were high at 200 and some amount of dollars. They actually dropped recently back down to this $169 point, and this seems to be their support level here. Looks like they fell back during that February-March pullback as well, back down to this time frame. So this could be a good buying opportunity. And we'll take a look at that here in just a minute more. So PE ratio, that's good. It's a pass. Next, I like to take a look at what are they currently priced. What is their dividend yield? Is the yield currently above their current, their trailing yield for the year? So this looks like if you were to buy the stock right now, you would get what looks like a 1.51% yield on paper here. But if we bring in their dividend, it says that they're paying $1.10. You'll multiply that by 4. That's $4.40. So their new payout ratio is 2.6%. So if you go here towards the bottom, looks like they just increased their dividend. So they increased their dividend payout by 55%, it looks like. They went from paying you out 50 cents per share to $1.10 per share. That's a huge increase there. And that's why this dividend here of 1.51 is actually way off. Their current dividend yield is at a 2.6%. That would be way up here off the charts, just way above any previous yield that you could buy this stock at right now. Now, is their price currently above or below their 200-day moving average? They are currently priced below their 200-day moving average. You can see here, let's go back and just look at just the 1 year. We can see here that for the most part, this stock was trading way above their 200-day moving average. Is pretty consistent over the last 3 years. There have only been several times here when the stock actually traded up below their 200-day moving average. This is one of those rare opportunities. If you bought into the stock here back in February or March, they quickly rebounded back into their highs. And maybe, I don't know what caused the stock. This would be something definitely to research as to what caused this stock to drop from over 200 and some amount of dollars all the way back down to its current price of $169.26. They just basically increased their dividend payout by 50%. They have a good going forward price to earnings ratio. I would probably take a look at over the last quarter, what did they tell their shareholders is going to happen in the future quarters? Did they lower expectations or something? Okay, so their PE, their price, and their 200-day moving average looks very healthy. Their dividend yield has shot up to record highs right now. Now, what is their revenue, net income, and free cash flow over the last 10 years? You can see that this company is in the billions. Many of the companies that I've looked at here, their revenue is generally in the billions, but their free cash flow and net income is usually sitting in those millions. So here, if we bring in our data format, change it to percentage-wise, over the last 10 years, this company has grown in free cash flow by 2.39,000%. This company's revenue has increased by, you divide this by 10%, You're looking at a 93.5% year-over-year increase in their revenue. You're looking at nearly a 40% increase in their net income year-over-year over the last 10 years. Now, this could kind of begin to balance out and kind of not go down, but kind of simmer down. But this is a semiconductor equipment and materials company that's huge right now. You know, voice chips being put into new phones, Alexa, iPhone's one, a whole bunch of devices you're going to be able to talk to in the future. You know, maybe your car, unlocking your car, maybe it's voice recognition. Who knows what's out there and available with semiconductor technology. So revenue, free cash flow, net income, that all passed. Their price is currently trading below the 200-day moving average. That passed. What is their price to book? What's their price to sales? And let's take a look at these back to regular data format. So if you were to buy the stock right now, let's just go back over the last 3 years. So Lamb Research, they had came up very quickly. You can see that they normally trade here on par. So let's see, what's the other metric? Let's bring in their PE. No, that's not the one. I feel like I'm missing something. Okay, let's bring in their price. Okay, so let's zoom in there just a tad. No, that didn't work out for me. Okay, so this stock here normally trades with the price to sales, you know, trading above that price and the price to book. It's usually the line on top here, but there was a bit of a change here during 2017 where their price in comparison to their sales had actually came down. So you're buying it at a very, if this stock had continued to go with that price, you would have seen the price shoot much higher in comparison to their sales. But their sales may be increasing year over year, where their price has been a little bit stale. Looks like since 2017, end of 2017, it really hasn't done much. So their price has just continued to, their sales have continued to grow quarter after quarter after quarter, whereas their price has been trending sideways. So that's why this price to sales has came down. It stopped climbing with the price and instead has fell down as their sales has increased and their price had stayed flat. Now their price to book value, again, did the very same thing. Their price to book value was, trailing right along with their price, but there was a transition here where their price did come down. They went from nearly a 6 price to book value down to a 4. So this is currently near or below a 3.0 for their price to book and price to sales. So that's pretty, value buying opportunity. I would consider it a value buying opportunity. Now, let's see, what is the next ones to take a look at? So let's go ahead and bring in these two new ones here. So if you were to invest your capital into Lamb Research, invested Lamb Research, what would your invested capital be? You would be looking at a 19.37. So this beats that 10% expectation. And we can see what's the history of it over the last 10 years. Well, the history of it is pretty healthy. If we bring in, so this has pretty much consistently stayed above the 10%. Let's just look at 5 years. So here, as of 2015, basically, this has consistently stayed above that 10% line. Are semiconductors going to be going anywhere? Not so much. There are other companies that do produce semiconductors. I would want to know, who do they produce and supply to? How strong is that bond with whatever company that they're selling that product to? But if we take a look at other companies here, let's do a comparison really quick over the last 5 years. We'll see that this one averaged right above that 10 and currently at a 19.37. If we take a look at ADP, this is kind of sporadic. It is kind of going up slightly and slowly, and it is way above that 10%. You can see here it stays positively over that 10% year over year. Procter & Gamble, it does dip below here and then kind of above and then kind of below, or, above still. The video, oh, it's always traded above that 10% there. Very healthy there. Apple. And this one's gone on for a long time above that 10% line. Only time here was that 98 crash. I'm not sure. Maybe they just had no products or services. Maybe that's when they had that tube computer they were trying to sell to people and nobody was buying. And they're like, hey, what else can we do? So Apple there. Okay, looking back at our 5-year, so overall, it does beat that 10% rule, and kind of going forward, I don't see this one dropping down anytime soon. So you're going to look at a 10% invested, a return on your invested capital over the next few years. Cash conversion cycle, how many days does it take them to convert your cash into cash flow from the users? This says 134 days. So if they do semiconductors, maybe some of their materials, it waits on the shelves for a while, gets shipped to whoever is buying them and put it into their devices, and then that company doesn't pay them until maybe they sell some of their devices or so. I'm not sure. I'm not sure why that one's a little bit high. But again, I haven't used these ones very often. This is actually my first time using this one. So seeing a high number of 134, whereas if I look at ADP, has nothing. Procter & Gamble has a negative 19. Nvidia has a 50, and Apple has a negative 39. So let's take a look at some of their comparables real quick. So in order to get comparables, LRCX, I like to jump over to CNN Money and just type in their ticker symbol, so LRCX, and that's going to get me the symbols. And then here on the page, towards the bottom right, you're going to see who are some of their competitors. We have ADI, KYOCY, MCHP, and SWKS. So I'm going to take Micron Technology. That's a pretty popular semiconductor company. We'll go ahead and use them as a comparable. MCHP. Okay, let's take a look at Micron's cash conversion cycle. This is 127 days. Lam Research is 134 days. So that's pretty spot on for those semiconductor stocks. MU, I believe, is another semiconductor stock. Micron Technologies, 76. Maybe, let's see here. Yeah, semiconductor. So this one's at a 76 days. So it's pretty normal to see those companies up there in those numbers. And if we take a look at, let's do some other comparables here with Micron Technologies over the last 10 years. Has this company been performing? It's in the triple digits. MU is in those triple digits. But if you look at our LRCX, triple digits, but much higher. So I would want to know who are they supplying. But overall, this company looks very nice. So I'm going to go ahead and leave that there for now, like the Y charts portion. Now moving over to dividend.com, looking at LRCX, that Lam Research Corporation. Again, we already know that they're a semiconductor equipment and material. They have been only paying out dividends for the last 3 years, which is when they began paying out dividends. So they don't have a whole lot of history here. They've started paying out dividends in 2014. They did, let's see here. Okay, they did raise it year over year for the last 3 years. You can see here they recently increased their dividend from 50 cents to $1.10. That's more than a 50% increase there. We can actually do the math real quick. Let's take the current one, which is, bust out my handy dandy calculator, $1.10 minus 0.5, divide it by 0.5, multiply it by 100, and you're looking at 120%. 120% difference from 50-cent payout to $1.10 payout. So that's a huge difference. Starbucks, JP Morgan, they increased their dividend by 30% or more. This one increased their dividend by over 100%. So what else? Payout ratio, very healthy. Even if it lost half their earnings, it would still be at a payout ratio of under 100%. This stock pays out they pay out every 3, 6, 10, 1, 3, 6, and 10. So this one's a little bit odd. Sometimes you see 3, 6, 10, or 3, 6, 9, and 12. This one is a 1, 3, 6, 10, 1, 3, 6, 10. So here it's like every 3 months, and then every 2 months, or every 4 months. So it's kind of an odd one. And here we can see their ex-dividends are 3, 6, 9, 12. Okay, that's normal. Okay, so 3, 6, 9, 12 is their ex-dividend, and their payout is, let's see here. Okay, it's usually same month, besides this January one. January one is usually pushed off just a little bit. So it's usually about a month before you get paid out, but who cares? If you're buying it for the long term, you're just getting paid out that dividend, and they did some healthy dividend increases here from 45 to 50 to $1.10. Okay, so that is that stock. Does that look like a great buying opportunity? Again, Going forward, PE is expected to fall, continue to fall. Their last 4 quarters have been profitable, not only just beating expectations, but really doubling or tripling expectations there. Also, they are currently trading with a dividend yield over their price. If we take a look at what's here, let's bring in Yahoo Finance, go to the statistics, take a look at their trailing yield. You look at their trailing annual yields at a 1.08. You're buying the stock right now at a 2.6% dividend yield. You're getting a yield on cost of 2.6%, which is higher than it's ever been, and what you'll probably get again in the future. They're expected to fall or climb. What is their expected price here in a year? $260.33, and they're currently priced at $169. So they're expected to climb by quite a bit going forward. What else can we take a look at? We could look at their financials, but I'm pretty sure their balance sheet's going to be, let's see here, let's see, going back, let's change it, oh yeah, we'll leave it annual. So here, this is in thousands, so all number are in thousands. We can see just year over year increasing in their revenue. Do they have any debt? So, I think it's on the next balance sheet. Okay, so here we have their cash and cash equivalents in this portion here. So year over year, so they may have made some purchases or something here in 2016, which is what caused their cash and cash equivalents to kind of drop there a little bit. Let's see if we can find liabilities. Okay, so they made some huge purchases. They had some short and long-term debt here that was pretty high. So maybe what they did here is they used some of their cash and cash equivalents in order to pay off some of their debt. And kind of going forward, you can see it drop back down to a normal, healthier level. So let's see, long-term liability, not to there, long-term debt. You can see their long-term debt has gone down. It was pretty high back in 2016, but they did use a lot of their cash or cash equivalent in order to pay down that long-term debt, which really helped them out. And now here you can see that their total liabilities is still a little bit higher, but not as high as back in 2016. So I expect 2017 to maybe that number to drop as well. And here we can see their net tangible assets year over year. Very nice, healthy increase there. 2.6 to 2.9 to then 3.9 to 5. 5. That is a thousands, millions, billions. So remember, we talked about this earlier. They were in that billions bracket, which most of the companies that I look at have only net income and free cash flow in the millions. This one's in the billions. So healthy looking financials there. Okay, so let's move on to our second stock we're going to be covering. We're already at 23 minutes. I didn't want to make this too long, but it is looking a little bit longer style video. Okay, so again, going back, what do we like to look at first? PE ratio and forward PE. Currently trading at a PE ratio of 27.99. Let's bring in, before we go a little bit further, let's just bring in, I'm just going to go ahead and get rid of these other ones. I'm going to go ahead and bring in some of their competitors. So ROP, who are some of their competitors? So that ROP. This is something I like to do. Okay, that one didn't pop up at all. Okay, wonderful. Is this a, let's see here, bring in, this is a, it looks like it should be a US traded company. Not sure. There it goes. I'm not sure why that wasn't showing up before. Okay. Yeah, I think I just clicked on profile too quick. Okay, back to quote. Who are their competitors? We have just a few here. Let's go ahead and move this window over. That way I can copy in my competitors. So we have FTV, we have EMR, we have MKSI, and ESE. So let's take a look at some of these. I'm trying not to make this video too long, but 27 on to 24. So that is our, what does this company do? So ROP, let's jump over to dividend.com. This is industrial equipment and components. So if I move down here towards the bottom, sometimes they'll give me a little bit of a company description. So they design, manufacture, and distribute energy systems and control scientific and industrial imaging products and software, industrial and technology products, and radio frequency products and services. It operates in 4 segments. So industrial technology, energy systems and control, scientific and industrial imaging, and RF technology. So it primarily in the United States, Europe. So it's not only national, it's international. Plus, it has 4 segments. So look, it's a pretty well-known company. And right off the bat, I can see 19 years of dividend growth. That's pretty nice. Okay, now let's look at their competitors. So 27, 24, 24, 21, 24, 21, 13, 11. And 22 and 20. So this one here, MKSI, this one is trading a bit, it's a little bit better price to earnings, but let's take a look. Let's just keep comparing here. Okay, so price and PE ratio on all of these are expected to fall. So going forward, they're expected to fall here, kind of going forward. Okay, except for this one. Yeah, this one's expected to climb. I'm just going to go ahead and get rid of that. Okay, so next, I like to look at revenue, net income, free cash flow over the last 10 years. Taking a look at how it has grown year over year. So revenues increased by 10% year over year. Free net income up 24% year over year. Free cash flow up 17% year over year. How are their competitors? You can see very sluggish in comparison. Their revenue only up 0.09% year over year. Their net income is at a 0.01, much, divide these numbers by 10, that's going to give you your year-over-year result. So 0.09, 0.19, 0.20, 1.90 and 2.09. So much lower growth there. Again, this company's in the negative numbers. That's why, it's not doing so well. This one's actually pretty good comparable. I'm going to go ahead and knock out these other ones and compare ROP to this company, MKS. I just want to check real quick to make sure MKSI. I just want to make sure it's in the same industry as well. Industrial equipment and components, diverse. Yeah, machinery, industrial. Okay, so yeah, it looks about the same thing. Worldwide company as well. Okay, so that's a pretty good comparison right there. I'm going to go ahead and continue to compare it against that. It doesn't have quite the, growth. Let's see here. So good numbers. I'm just going to go ahead and just, those are good numbers. Okay, so revenue, free cash flow, net income, that all passes there. Take a look at their price and dividend yield. For the year, where is this one at right now? Going back to our regular data format. This stock, Roper Technologies, you're getting it at around a 0.57, 0.60% dividend yield at this current price. It has been trending sideways for how long? Not too long. Looks like January, it did kind of come off those highs, but it quickly recovered. It did kind of fall again in March, quickly recovered, has kind of trailed down. Let's go and also bring in, let's see, what are we looking at? Their earnings. Okay. Those last 4 quarters, they have beat and, exceeded their earnings estimates. So that's good there. So this one here, the other one was also trading price under yield. Let's see, what was I wanting to do? What are they currently paying out per share? So this one increased their dividend from 35 cents to 41 cents and 25, basically, a quarter of a cent there. They may pay out they may pay out one more time at this 41 cent dollar, or this 41 point, and then they may increase it again. That's what they kind of do. These sort of companies that have been paying out this dividend growth and continued dividends from back in 1999, they like to increase their dividends year over year. This one looks like it normally pays out 4 times, and then it increases it in the 5th time. So I could probably see that kind of going forward, that this is what, that's what this company would do. No guarantees. Let's go ahead. Okay, how to text. Let's see here. So back to price and yield. Okay, get rid of that yield. Bring in our 200-day moving average. This stock is trading above its 200-day moving average, so not as great of a value buy right now. You can see that there are buying opportunities here. You can see back in 2016, it was trading below its 200-day moving average, but for the most part, it does trade not only above its 200-day moving average, but quite a bit above its 200-day moving average, sometimes by a pretty good percent there. So it did come back recently and touch that line. Not quite. I wouldn't consider that touching, but those would have been really good entry points for a stock that's normally trading above its 200-day moving average. Let's take a look at MKS. Let's bring in its yield as well. Just look at the same information. This one came really off its highs. You can see here this one was at $120 plus, whereas this one has been more trending sideways for the most part. Dividend yield's right around that same. Okay, and their 200-day moving average. This one is currently trading below its 200-day moving average. History of it, for the most part, it likes to trade above its 200-day moving average, but this one does look like a good buying opportunity. But we're just kind of looking at ROP right now, but you can still look at MKSI as well. So let's see here. What is next? We've got price. We got 200-day. It is trading above that 200-day. Okay, now I like to look at price to book, price to sales, and price. So where does it like to trade at? Well, this one is very crazy. Okay, so price, you can see that the price to book, it's split off here. So what happened? Their book value, okay, so if their book value has remained the same, but their price has climbed, that could mean that they're taking in more, let's see here, they're taking in much more assets and their book value is growing much faster than their price is growing. So instead of their price continuing to grow with, or their price to book value continuing to grow with their price of the stock, it has stalled because their book value has grown faster than their price of the stock has grown in that time frame. You can see here though that their price to sales, it has continued to climb. So this one's pretty, pretty normal for this metric here. So let's take a look at, so it's climbed, but again, it's been kind of flattening out here and staying around that 6. So their price in comparison to their sales, so if their sales are going up and their price is going up, you would see that number start to decrease, as we had saw in the previous example, that their price had stayed flat, but they were increasing their margins quarter after quarter, and that was causing their price to sales ratio to drop here. This is the one we looked at. So their earnings and their sales are climbing crazy, but their price has stayed mainly flat. So that's what we like to look for. That's good. Okay. So this is a little bit high at a 6.0, but if we compare it to its competitor, okay. So its competitor here has actually a price to book value of 3.0 and 2.6 for its sales. This actually looks like a better buying opportunity. Just kind of looking at the overhead. It's 200-day moving average. It's actually below its 200-day moving average, whereas Roper Technologies is slightly over its 200-day moving average. This one does have a little bit higher revenue, free cash flow, net income growth over the last 10 years. And their price to book, price to sales is at healthier looking numbers. And their price has came down below that 200-day moving average. Okay. Now let's compare these ones for return on capital. Here we're looking at a return on capital for the, the head came down quite a bit. You can see here that it's not really consistent. This company, for a time, it was trading or kind of keeping above your return on capital would hover between a 7.2 and a, say, 9 some percent return on investment capital. So 7 and 9 here at MKS. After that mini crash here, 2008, they did fall where your investment. What happened to their price? Okay, so not sure what happened here. Maybe people stopped buying. This is an industrial company, so maybe during hard times, people don't buy as many, sets of equipment and grow in their facilities. So people stop buying this one. So your return on investment really dipped there into the negative. but after that recovery, it kind of bumped back up and has continued to sort of be above. This one's at that 6 to now it's at a 19.28. So maybe they've recently changed it up. They're looking at a more profitable business. I'm not sure which one of those are actually, let's see here. Let's get rid of that price. 18.8.65 and 19.28. That would be your return on investment capital. I'll have to, oh, okay. Okay, we're doing a comparison between these two. See, I lost track of where I was. Okay, let's move on to cash conversion cycle. I really need to read a little bit more up on these, on how to use them better. This is my first day. I kind of went back and forth with him yesterday, and I read about them. I need to go out there and, read a little bit more, watch a couple of videos on how to use these to the best extent that they can be used. But we can still use them for comparisons between two like companies. So Rope Technologies, we're looking at a 71-day conversion between their, let's see here, let's go back there, between their converted resource inputs into cash flows. So the amount of time and days that you would need to have your dollars tied up in production, or they would need to have their money tied up in production developing these products before a sale process occurs. So it's 71 days for them. MKSI 138 days. So basically double here for MKSI. So that is basically it. Let's take a look here at their dividend, at their dividend.com information. MKSI. Okay, this is MKSI. I'm not looking at that one. I'm looking at Rope. Okay. Again, this one has paid out dividends for 19 years. Not only paid out dividends, but have continued to raise their dividend year over year. Their payout ratio is at a very healthy 14.7%, which is one of the lowest payout ratios I have seen on just about every dividend stock. But again, their dividend yield is only at a 0.6, so they have quite a bit of room to grow. They're actually below the industrial goods average at a 1.15. We can see here that they don't have much of a history. Oh, they do have. Okay, that's right. They've been trading out dividends for quite a while. So 19 years. So they do have a pretty healthy dividend track record here. They did a stock split way back when in 2005, where you would get two for every one that you had. So this is just sort of a consistent grower. This one, let's take a look. Spots out the handy dandy calculator. 0.4125 minus 0.35 divided by 0.35, multiply it by 100. You're looking at an average increase in dividend of around 17% there, 17.85. And see, 0.35 minus 0.30 divided by 0.30. Okay, so it looks like they increased their dividend about 17% year over year, and they've consistently, they've done that for the last couple years, and they have grown it over the last 19 years. So if you're looking at a pretty good long-term buy and hold with consistent dividend payouts, you're not going to get a huge dividend yield. The LRCX is going to give you a much better dividend, a yield on cost right now. This is actually trading below its. I had said earlier that it's actually trading above. Oh no, it is below their current yield. This yield's like way up here right now, and they're expected to fall. So overall, of these two companies, I think they are both great looking companies. They've all passed the financial metrics overhead. So starting at the beginning, they all have great PE ratios in comparison to some of their competitors. Moving forward, their price to earnings is expected to fall, meaning their earnings are expected to increase. Their net income, revenue, free cash flow over the last 10 years have not only been in double digits, but triple digits. So very healthy year over year growth there. Their price and yield, they're currently both trading below currently below the average for your yield on cost. You're getting these at a good price in comparison to their yield for the year and in the history. You can see here Lam Research, for example, increased their dividend by 110%. So you can see that their price going forward, we can take a look here at ROP. What's their 1-year estimate for ROP? It's at 312. So this is 276. So this is like a $40 difference. Whereas if you're looking at Lamb Research, their future expectations, let's bring in this one here to go back to summary. You're looking at 260. They're currently at 160. That's a $100 spread right there. So much they're expected in the future. This one's going to be turning around quite a bit. I would say that Lamb Research does look like the better short-term buy for the next year to 5 years if you're looking, and you're also getting a great yield on cost, nearly a 3%. So for every $100 that you're invested into this company, you're getting 3. If you're investing $1,000, you're getting $30 back per year. And if you just continue to reinvest those dividends, it'll just build up. So going back, we left it off at PE. Oh, also, their price to book, price to sales looked really healthy. Dividend growth looked healthy. Their Lamb Research was trading. Was it trading above or below? Okay, it was below its 200-day moving average. And ROPE was not trading above its 200-day moving average. MKSI looked actually like a better deal in comparison to ROP. But, man, we are at 41 minutes. Okay, that is it. I am done. If you did like this video, remember to like, comment, and subscribe. Again, this was a recommendation. I may have taken way too long and went over all sorts of unnecessary information. But again, as a funny disclaimer, I am not a financial advisor or tax professional. The information provided is my opinion for entertainment and fun. This is not investment advice. This is just me as a financial investor myself, trying to help others make their money work for them. This is a suggestion by you guys, the subscribers and viewers. So if you do have any other ones you guys would like to check out, hopefully not anywhere near as long and as off topic as this one has been. So thank you guys for tuning in. I will see you next time. Have a great day. Bye.